Every day, people jump into crypto hoping to get rich fast, but instead of making money, they keep losing it, and they don't even know why. It's not just bad luck or market crashes. The real reasons are hidden, and no one is talking about them. In this video, we're breaking down the truth behind why you keep losing money in crypto, so you can finally stop bleeding money and start playing smarter. Make sure you hit the subscribe button and press the bell icon to get regular updates. Let's dive in. Number 11. You're playing an invisible game. One of the most dangerous things about crypto is that it feels like an open playground. You see charts, prices, and exchanges, and it seems like everyone has an equal shot. But the truth is, the market is not built on fairness. Behind the scenes, there's a constant battle going on between smart money and retail money. Smart money includes institutional investors, experienced traders, and those who deeply understand the mechanics of how the crypto market works. They study liquidity, market cycles, and human psychology. Retail traders, on the other hand, often chase whatever is currently pumping, reacting emotionally instead of strategically. If you're not aware of the kind of market you're operating in, then you're not playing the game. You're being played by it. Number 10. FOMO is engineered. Fear of missing out isn't just something that happens naturally in crypto. It's manufactured. Big players accumulate tokens silently while no one is paying attention. Then suddenly, everything changes. Influencers start tweeting. YouTube thumbnails turn red and green with rocket emojis, and the token begins to trend. You see a huge 50% pump in just one day and feel like you're missing the opportunity of a lifetime. But what's really happening is that you're being positioned as exit liquidity. The smart money that got in early is now selling their bags to you. FOMO isn't just a feeling, it's a tool. And unless you learn to spot how and when it's being used, you'll keep being the one left holding the bag. Number 9. You don't have an exit strategy. A lot of people in crypto spend all their time obsessing over when to buy. They set alerts, watch price action all day, and try to catch the perfect entry. But very few ask themselves, when should I sell? That's a huge mistake. Crypto moves fast, and sometimes it moves violently. You can watch a coin shoot up 200% in a week, and if you don't take profits, it can crash back down just as quickly. Without a plan to lock in gains, most people end up riding the wave up, and then right back down. Worse still, they convince themselves the coin will bounce back, even when all signs say otherwise. An exit plan isn't optional. It's essential for survival in this space. Number 8. You misunderstand the real use of projects. People love to throw around the word utility in crypto as if every coin is solving a huge real-world problem, but in reality, most projects exist not to solve problems, but to raise money. Some are launched purely for hype. Others promise the moon, but never actually build anything useful. The truth is that real utility in crypto is rare. The coins that truly stand out are the ones solving actual problems, like stable coins helping people in countries hit by hyperinflation, or DeFi platforms offering banking solutions to the unbanked. If a project doesn't have a real urgent use case and adoption in the real world, then your investment is probably just a gamble dressed up as a tech revolution. Number 7. You trade illiquid coins. It's tempting to go after low-cap coins because they promise massive returns. You hear stories of people turning $100 into $10,000 overnight, and you want a piece of that action. But what many don't realize is that low-cap coins often suffer from one major problem: low liquidity. This means there simply aren't enough buyers and sellers in the market to support larger transactions. Try to sell $1,000 worth of a coin that only sees $20,000 in daily volume, and you'll instantly crash the price. Low liquidity can leave you stuck and unable to sell without taking a big loss. It doesn't matter how high a coin pumps if you can't cash out when you need to. Number 6, you fall for Twitter hype. Crypto Twitter is full of charts, alpha drops and meme-filled threads that make you feel like everyone else knows something you don't. But the harsh reality is that most of the loud voices on Twitter aren't actually making money from trading. They're making money from likes, retweets, affiliate links, and sponsored posts. Their job isn't to tell you the truth, it's to keep you engaged. The real alpha, the strategies and insights that actually make money, almost never get shared publicly. If someone has a winning strategy, they're not broadcasting it for free. So if you're basing your trades on what's trending on Twitter, chances are you're getting played, not informed. Number 5. You ignore token unlocks. A lot of new crypto projects launch with only a small portion of their tokens in circulation. The rest are locked, sometimes for months, sometimes for years. But eventually, those locked tokens are released according to a schedule. And when they are, it can cause a flood of new supply in the market. Even if the project is fundamentally strong, prices often tank simply because the market is flooded with more tokens than there is demand to absorb them. If you're not looking at the tokenomics, especially the unlock schedule, you're walking into a price drop you could have easily avoided. Number 4. You don't respect market cycles. One of the most dangerous mistakes is ignoring market cycles. Crypto doesn't move randomly. It goes through a pattern: accumulation, expansion, distribution, and collapse. During accumulation, smart money quietly loads up. In expansion, hype begins and prices rise. During distribution, insiders begin to offload while everyone else is excited. Then comes collapse, the part where most retail investors are left holding worthless bags. If you're buying when everyone is talking about the same coin, chances are you're already too late. The smartest entries are usually made when no one is watching, and the best exits are during peak euphoria. Learn to read the cycle, and you'll stop being its victim. Number 3. You misuse leverage. Leverage trading is one of the fastest ways to destroy your portfolio. The appeal is obvious. Small amounts of money can lead to huge gains, but it works both ways. Using 20x or 50x leverage means that even a tiny price movement can liquidate your entire position. What many people don't realize is that large players know exactly where retail stop losses and liquidation points are set. They use that information to push the price just enough to trigger mass liquidations, and then reverse the trend. If you don't have strict discipline and solid risk management, leverage isn't a tool. It's a ticking time bomb. One wrong move, and your whole account is gone. Number 2, you overtrade. Crypto markets are 24/7, and that constant movement makes it feel like you always need to be doing something. But overtrading is a silent killer. The more trades you make, the more emotional you get. You start chasing setups that don't exist, entering positions just because the chart looks interesting. You rack up fees, exhaust your focus, and begin to lose clarity. Great traders don't trade more. They trade smarter. Some of the most successful people in the space only make 2 or 3 trades a month. They wait patiently for the right moment, the right setup, and the right conditions. In crypto, patience isn't just a virtue, it's profit. Number 1, you invest. Based on hope, not data. Saying, "I believe in this project," is not a strategy. Belief without evidence is just hope, and hope is not a foundation for investing. Real investing means doing research. You need to look at real metrics. How many people are using the platform, how much revenue the protocol is generating, whether the developers are actively improving the code, and whether the community is growing. Would you buy a company's stock without knowing its earnings or business model? Then why do it for a token just because someone said it's the next big thing? Blind faith in crypto often leads to blind losses. So now that you've seen the real reasons why people keep losing money in crypto, which one do you think is hurting your portfolio the most? Let me know in the comments below. Hit the like button and subscribe to our channel for more updates. Thanks for watching.